The MMT has 9 million assets under management, and one of the reasons is because we know how to simplify things. And a major thing that we have simplified is entries and a market maker model. So in video number 11 in the MMC series, we are going to go over entries and market maker models as well. The first thing I need you to understand is the following, that entries are the easiest part, at least they are supposed to be the easiest part, because the hard work is done on the higher time frame. So the hard work is what happens before you look at an entry. Now, this does not mean that your entry is not important, because getting the right entry is still very much important, because not using your entries well enough might result into missing out on RR, might result in extra losses as well, which are very much avoidable. But entries are not going to make or break your trading plan. The hard work is again done what happens before the entry. So the direction, the narrative, the context. So if you struggle in trading, it's most likely not because of your entry. It's because you're not that good at finding high probability conditions on the direction, on the narrative, and on the context. So with that being said, we can move on. Now, where do we again look for entries? This is already what we've gone over, right? We always look for entries inside context areas. So this is the area we take a trade. We are always trading usual context, which again comes down to this order flow lag on the left side right there. Let's say we have a context area on the daily time frame. We can look for 15-minute entries. And again, you can just switch the time frames. So for example, if you have a 1-hour context area, you can also take 1-minute entries. Then once you have found that context area that you want to trade from, you need to understand that entries are all about fair value gaps, nothing more. So the only thing that you focus on with entering in the market is fair value gaps. Now, there are two types of entries that we can use, which are essentially the same. And why they are the same is something we'll go over later on as well. The first one is a sharp turn, a fair value gap in and a fair value gap out. Fair value gap in, fair value gap out refers to the context area. So a fair value gap into the context area, fair value gap out of the context area as well. And the second type of entry that we can use is order flow lags, so lower time frame order flow. Now you'll see that these go hand in hand because it's essentially all based on order flow. And order flow is then all based around fair value gaps. So we could argue it is all about those fair value gaps. Now, moving on. Before we get into the specifics how we can enter from those sharp turns or from those order flow lags, we also need to understand what type of time we have. Meaning, like we mentioned for context areas, we want to see higher time frame time. And higher time frame time was in the form of those news events. They bring the volatility to the market. That's when a PD ray is the highest probability, when ideally we also have it aligned with the right news event. Now that higher time frame time, like it already says, that makes the higher time frame really move. Which of course, when the higher time frame moves, it also makes the lower time frame move. But it is also very important to understand what helps the lower time frame move even more. And that is the following. When we look at lower time frame time, that refers to sessions, in other words, also kill zones. And for some entries, we would like to have lower time frame time also agreeing with the entry that we are about to take. Now, what is lower time frame time? First of all, we need to understand that the lower you go in timeframes, the more relevant a session/kill zone is. When we talk about lower time frame time, 15-minute time frame and below is the most relevant. That's where you are going to benefit from using lower time frame time. If we are talking about 1 hour and above, I would argue you don't really need to focus on this. Now, what I do want to mention specifically with the lower time frame time subject right here, if you take trades and you feel like you don't need it, perfectly fine, remove it from your trading plan. The approach you can also take is simply take any trade that you see, gather the data on those trades, and then after a while you can take a look at the trades that you took and see, okay, what do the winners have in common and what do the losers have in common? And when you then come to the conclusion that that time does not filter out any winners, but it does filter out a lot of losses, that's when you can also look to implement time. So lower time frame time right here, take it with a little bit of grain of salt. It is important, yes, but if there's no data supporting the idea that it is in fact important, then you can also trade without it. Moral of the story, every trading plan is different and gather your own data. Now, when we talk about 1 minute or 5 minute entries, then in my opinion, they definitely are very much important. Now, when I talk about time in Forex, I refer to the following session or the following kill zone. And that is from 2 a.m. to 10 a.m. These times are in New York local time. So on TradingView in the bottom right, you'll see a time. You can click on it and you can change it to New York. If you always have it on New York, you do not need to worry about times changing when daylight time savings comes as well. Because the times we refer to is always based on New York and it stays that way. Now, as a general rule of thumb, between 2 a.m. and 10 a.m., that's where the most volatility is. That's where you can see the fast price action. Between 2 a.m. and 10 a.m., that's ideally when you want to look for trades. Outside of those times, you don't want to look for any trades. Now, there's some nuances to it that we're also going to go over. When we talk about trading something like the indices right here, then we want to focus on 9:30 a.m. to 4 p.m. At 9:30 a.m., you have equities open for the indices. That's where a lot of volatility comes into the market directly. Then until 4 p.m., which is known as the bond closing hour, that's where the volatility dies down because the market also closes. So if you're looking to trade something like ES, NASDAQ, YM, or Russell, then focus on placing a trade between 9:30 a.m. until 4 p.m. Now, to me, time nowadays especially is completely blown out of proportion, and you see magical times 10:15 a.m. all of a sudden popping up out of nowhere. Not data-based, nothing, just out of thin air. And if you do want to use a very specific time, then again, make sure it is backed up by data. But time is such a cryptic, such a mysterious, such a vague concept nowadays, whilst it's quite simple. Time refers to volatility again. So a specific time of day where there will be increased volatility. And I'm going to shatter a lot of gurus, their beliefs, but you don't need anyone to tell you what specific time to trade. All you need is a simple volatility calculator. So if you Google volatility calculator euro US dollar, then the top result will be marketmilk.babypips.com. Then here there's a lot going on, but I want you to focus on volatility per hour. You put this on the last 6 months or the last 12 months, doesn't really matter as long as you have some significant data. Then when you look at the volatility per hour right here, you will see the times where it is more volatile and where it is less volatile. So for example, right here in the middle of the night, the volatility really dies down for euro US dollar. That's when you ideally don't want to trade. You want to trade when the volatility is above average. Make sure you check the time zone that is in the bottom right there. And if we take a look at something like Australian dollar JPY, for example, since these are known as Asian session currencies, you will see that right here in the middle of the night, it's a lot more volatile. The volatility is a lot more balanced throughout the day right there. So again, you want to focus on trading when the volatility is above the average line right there. And again, you can do the same thing for any instrument that you want to trade. If you want to trade something like US oil, for example, then check here the volatility per hour and it tells you the ideal times to trade. Where there is the most volatility, that's ideally when you want to look to trade. And you can do the same thing for gold or silver or whatever instrument that you can think of. So hopefully that makes sense that it's not something magical. It is just simply volatility. That's about it. So if you are just starting out and you wonder when you should trade, then just simply take a look at a volatility calculator. Now, the next thing you need to know is time frame alignment. So when we talk about time frame alignment, it's very important to understand that the closer the context time frame and the entry time frame are to each other, the less confirmation you need. So what does that mean? Well, we have gone over those context areas, and those context areas are on a certain time frame. For example, like we mentioned, we have a daily context area. Then if we have a daily context area and we are going to look for 4-hour entries, we don't need a lot of confirmation. But if we are going to look at a daily context area and we are going to confirm using entry confirmation in that context area on the 1 minute time frame, then we are going to need a lot more confirmation. this leads back to that fractal understanding where multiple candles make up one singular candle. So with a bearish daily fair value gap that you're trying to trade from, a 4-hour bearish candle is already a lot of confirmation. Inside that 4-hour bearish candle, you have a lot of 1-minute fair value gaps as well. But if you dive straight into the 1 minute from a daily bearish fair value gap, you are first going to need a lot of bearish 1-minute fair value gaps before that turns into a 4-hour down candle. So you need to find a balance there. To help you out with that, this is the following balance that you can focus on. For sharp turn entries, focus on the following. If you have a monthly context area, all the context area timeframes are on the left side, all the entry timeframes are on the right side. So monthly context area, daily sharp turn. Weekly context area, 4-hour sharp turn. Daily context area, 1-hour sharp turn, then the 4-hour, 50-minute, 1-hour, 5-minute, 50-minute to the 1 minute. The 50-minute is the lowest context area. 5-minute context areas, would not advise it. Stay at the 15-minute or above. Then for order flow entries, focus on the following. On the left side, again, the context areas. On the right side, the entry time frame. So monthly, 4-hour, weekly, 1-hour, daily, 50-minute, 4-hour, 5-minute, 1-hour, 1 minute, and the 50-minute, again, the 1 minute. Because I would also not advise to go below the 1 minute time frame. Just use the 1 minute. Now, I need you to understand, these are the minimums. So don't go below it. Meaning, sharp turn, don't use monthly context area with a 4-hour sharp turn. You can go up, yes, you can use a monthly context area with a weekly sharp turn. That's perfectly fine. But these are the minimums. These are what I like to call the baseline. We can go up, yes, we cannot go down. Then it's finally time to dive into the actual entry pattern. Now, the first one that we have is the sharp turn. And a sharp turn is the following. We have a fair value gap in to a fair value gap out. Again, referring to that context area. This fair value gap in first to then that fair value gap out is manipulation. So think about, again, the liquidity sweep that we talked about. This is trapping those traders. And the fair value gaps don't have to be overlapping. On the left side, it all starts with a PD array. Again, referring to that context area. When we trade into that on the lower time frame, we ideally want to see a fair value gap going in to then a fair value gap going out. That traps traders who think it is going long, but instead it is going lower and we are going short. Then the bearish fair value gap right there can already be an entry, and your stop loss, you want to place it above the most recent order flow lag in a bearish situation. A bullish situation, stop loss below the most recent order flow lag as well. These two fair value gaps that we have right there in this example are overlapping, but they don't have to be, as long as it's fair value gap in and eventually fair value gap out. The faster it happens, the better the sharp turn. The slower it happens, the worse a sharp turn. Again, it's a sharp turn. Now after this, I want to go over sharp turn examples, but before we do that, I also want you to understand order flow entries, because they're essentially the same thing, just on different time frames. We talk about order flow entries when we go down time frames. So if we go up time frames, again, we need less confirmation, so it can just be a sharp turn. But with order flow entries, a sharp turn will most likely also happen. Again, order flow entries is based on order flow lags. We start off with that PD array, that context area. We trade into it right there, and like we see, we also have a sharp turn. And what makes it order flow is that we trade back into a premium array and we continue lower from that. So instead of one order flow lag with a sharp turn, we have two order flow lags. And that is essentially an order flow entry. Again, entries are the easiest part if you be following along with the videos, because then it all just comes together. Now, this is the basic understanding of order flow entries, but this is already enough in my opinion. If you want more understanding of order flow, then the MMT, for example, is also a great place. Now, before we go into examples on the chart, we first need to understand a concept that we have gone over before in this series, and that is that market structure is order flow, and that order flow is candle science. Remember that it just depends on what time frame you are looking at. So, time frames again, a short-term high is an intermediate-term high, and a short-term low is an intermediate-term low. So for example, right here on the daily time frame, we can have a short-term high and a short-term low right there, whilst on the 4-hour time frame, That could be an intermediate term high and an intermediate term low. And in this video where we mentioned it, which was order flow and market structure, we mentioned as well the reason why this is so important is because so we don't get lost in the lower time frames later on. And now we have arrived at the lower time frames. So how does this then translate over to understanding those entries as well? Because if we take a look at Canadian dollar JPY, an example we have used before as well, we target this intermediate term low right there on the daily time frame. Then towards that, we have unusual context right here. Now in unusual context, you have the PD rate you want to trade from, which in this case, the fair value gap, you could also argue the fair value area. Perfect. The important part right there is the following. It's the target. This target right there. Because what is that target? That is a short-term low. But what is that short-term low if we go down a time frame? For example, on the 4-hour, that short-term low turns into an intermediate term low. For your entries, that means that you are always looking to target an intermediate term low right there. And you are trading the confirmation of an intermediate term high right there, which right here happens on this sharp turn that we have. That 4-hour fair value gap lower, which in itself can already be an entry. And the way you can enter from that is simply entering in the fair value gap, covering the order flow lag high, to then targeting a 1 to 2 RR. 1 to 2 RR is all you need, especially if you're just starting out. But let's say you don't want to look for 4-hour entries and you want lower time frame entries. Then this 4-hour fair value gap that we can continue lower from, we don't have to use it as an entry. It can also be as a new context area, right? From that fair value gap towards this swing low, that short-term low. But that short-term low, if we go down time frames again, for example, on the 15-minute right here, then we can see it turns into an intermediate term low. And if instead we want to take a look at our order flow entries, we can also use the 5-minute. Well, on the 5-minute, again, that low is an intermediate term low. Now, why is this so important and why am I emphasizing on this? Is the fact that when we have a context area, we are always looking on the lower time frame to target an intermediate term low or an intermediate term high, which is the target of the context area just on a different time frame. So on our entry time frame, 9 out of 10 times it's going to be an intermediate term low or an intermediate term high. And why is this then important? Is because this is a market maker model. A context area is a market maker model. And if you're not familiar with a market maker model, then, well, you already were because you understood context areas. There are many, and I emphasize on the fact, there are many concepts involved in this trading plan that you do not need to pay attention to. So again, I want to mention that if you start incorporating other concepts that are not discussed in this series or in the MMT in general, then you might just end up adding a concept that is already in the trading plan, but that you don't need to pay attention to. That is simplifying. Simplifying is not for idiots. Simplifying is for people who understand the concepts so well, they can transform 10 rules into one singular rule. Because before going into this video, if you've watched the different videos on the MMC series, you understood order flow, you understood context areas, so you already understood what a market maker model is. And then why is this simplifying so important? It's because the trading plan, the technical analysis, allows you to keep your psychology in check. So if your trading plan is very simple and you don't need to put a lot of thought into it, well, it's very easy to keep your emotions in control as well. A lot of people are distracted by the chart where there's so many things they need to think of that they forget to think about their psychology. So they're distracted by the chart, they're a feather in the wind, and the market takes them on a crazy emotional roller coaster. And this market maker model is the exact same. So this right here is a market maker sell model. We have the consolidation at the lows right there. We have the sting into the context fair value gap, the boundary. Then after we get the confirmation, we continue lower right there until we reach these lows right here. And this is our context area. So the PD rate that we can continue lower from towards the low sitting right there, that's where we want to look for our entries. So again, on which time frame you get the sharp turn, it doesn't really matter, because if you're trading order flow lags on one time frame, you're most likely going to have a sharp turn on another time frame. It's all fractal. The same thing happens just on a different time frame. So here on the 5-minute time frame, we have this fair value gap going lower right there. We trade back into it. Afterwards, we create new fair value gaps sitting right here, which we can also continue lower from. That right there, that second order flow lag is our entry. We enter in the fair value gap, cover the order flow lag high sitting right there, and we target a simple 1 to 2 RR. And whilst this is happening on a different time frame, it will form a sharp turn. So do you need to pay attention to both a sharp turn and these order flow entries? No, you absolutely do not need to. You need to pay attention to one of them. Either order flow, so you're going to go into lower time frames, or sharp turn. You need to pick your poison. And the reason why I mentioned you need to pick your poison is because sometimes a sharp turn entry will be the better entry, and sometimes it will be an order flow that will be the better entry. But you need to master one of them. You can't keep switching between them. And then all we're doing right here is following the order flow lags to continue lower. But the more time that passes, because time keeps on ticking, the more candles we create, the more fair value gaps we are also going to create above the 5-minute time frame. Why is that important? Because this 5-minute fair value gap right here is not in context, like we've gone over in earlier videos, of the 15-minute anymore. Why? Because this 5-minute fair value gap right here, let's see. On the 15-minute time frame, it's the exact same fair value gap actually. On the 15-minute time frame, we do have a fair value gap above right there, but it's also the same fair value gap. Is this 15-minute fair value gap then right here in context of the 1 hour? Meaning, if you go up to the 1 hour time frame, then we see no, because the gray box that we have right here is below the 1 hour fair value gap that we can continue lower from. So all the order flow lags are in context right now, meaning that we had this daily fair value gap right here. There was no weekly fair value gap above that daily fair value gap. So the furthest we can retrace and continue lower from is the daily fair value gap. The same thing happened right here on the 4 hour time frame. After that, we have the 1 hour time frame right there. So there's constantly no reason to retrace anymore because everything is in context with the time frame below it and the time frame above it. And that is your focus until we then reach the context target, which is this intermediate term low right there. Now, a question that might also arise is the following. Why target a 1 to 2 RR like this if you can simply target all the way towards the intermediate term low right there and get 9 RR? Well, that is because of a simple fact, and that is that context areas will not always follow through all the way towards the lows. So think of it in a probability manner. Trading is all about probabilities. What is the highest probability thing for price to do right here? Is that we at least get a retracement back into the 4 hour value gap. What is below that, potentially still high probability, but within the higher probability, lower probability than retracing back into the fair value gap, is that we get a rejection from that fair value gap. Now, what is lower probability than get a rejection from it? Is that we get an entry. And what is lower probability than that? Is that we get a 1 to 2 RR. What is a lower probability than a 1 to 2 RR? Is reaching the intermediate term low right there. What is lower probability than that? Is actually running the low and not sweeping the low. So the further your take profit, the more you are going to require from price action. And when you are just starting out, especially because people will promise you the world and people will promise you 130 RR trades every single day, it just won't happen. Do not get ahead of yourself and just simply, first of all, focus on 1 to 2 RR. And eventually, if data is supporting the idea that you can target further, then you can increase your RR. But a 1 to 2 RR has a very nice combination with a win rate, which will help a lot with your psychology. The more RR you are going to target, so 1 to 10 for example, the lower your win rate is also going to be. So if you have a 1 to 10, you can take 9 losses before you take the next winner and you are still profitable. Yes, but how many people are going to take 9 losses and not mess up one time in their trade ID, over trading, revenge trading, taking trades they shouldn't be taking? So high RR does not always mean that you overall have a higher return. There's a lot more going into it than what's on the surface. So here on Canadian dollar CHF, we had quite a clear target in the form of this low. How to do a top-down analysis is something we are also going to go over in the next video. Both trades right here that I am showing you, fun fact, are both trades that I also took and that were winners. Just to confirm to you that yes, this works in real time, very much so. We had this daily fair value gap right there, which we had a sting into it, which we can also continue lower from. Now that daily value gap has a context target, which is this low right there. Again, this is the main low. That is that intermediate term low if we now start going down time frames. Which time frame you go in until this moment, that's up to you. As long as you focus on those order flow lags, then you will be all right. So let's say we go into the 15-minute time frame. Now from that daily fair value gap, we see we have a perfect sting into it on the 15-minute time frame. We have our first fair value gap to continue lower from right there. Afterwards, we also get this fair value gap right here. The first fair value gap that we actually trade back into. Then this fair value gap right here, if we were to enter off that, cover the order flow lag high right there, target a 1 to 2 RR. Again, we see that the 1 to 2 RR is reached quite fast afterwards as well. Now we follow along with price and we actually go up time frames to the 4 hour. Then on the 4 hour, eventually we see lower prices. We leave behind this swing high right there. That swing high is potentially what we can sweep to then continue lower. Again, like we mentioned, that is also a context area. From the swing high right there to this low. This is the context area. If we were to go into the 1 hour time frame, then we see we have another fair value gap right here, confirming the sweep, which we can then also continue lower from, creating a new context area, 1 hour value gap towards this 1 hour context low. Then right here, diving into the 1 minute, we also see with very blocky price action that we have a 1 minute sharp turn right there. And afterwards, we also have a new 1 minute fair value gap right here that we can continue lower from, creating that new order flow lag, targeting again a 1 to 2 RR. If you are looking to trade the 1 minute time frame, I would advise take a look at the indices instead. The 1 minute time frame of Forex tends to be a little bit of a more difficult time, but on the indices, it is perfectly fine to trade. Following those order flow lags towards that intermediate high or that intermediate low, that is essentially what entries are all about. It's all about those fair value gaps, like we mentioned. And that's why I mentioned it's arguably the easiest part, because it's all things we've already gone over. Now, there's a few things to this. And the first thing is choose your baseline. So what I mean by that is, again, choose your entry confirmation. Is there going to be a sharp turn? Is there going to be 2 order flow lags, 3 order flow lags? Choose your entry confirmation. The reason why this is so important is because price action, the context area that you are going to trade from, is not always going to be extremely high probability. And when it's not extremely high probability, you want to focus on getting extra confirmation. So extra confirmation from that context area on the lower time frame. And extra confirmation is going to be above your baseline. So let's say you require 2 15-minute order flow lags from a daily context area. Then that is your baseline. You cannot go below it, but you can certainly go above it. So 3 order flow lags on a 15 minutes from a daily context area, or 4 or 5. The more order flow lags, the more confirmation you are going to have. And the more likely that a context area is actually going to hold. And when we talk about extra confirmation for a sharp turn entry, if you use a sharp turn entry and you look at a 1 hour sharp turn from a daily context area, but the context area, you're not too convinced on it, you're not sure if it's very high probability. Okay, you want extra confirmation. Instead of a 1 hour sharp turn, you can go into the 4 hour and wait for a 4 hour sharp turn instead. And that is above your baseline. When you focus on sharp turn entries, ideally focus on going up timeframes. Now, the reason why this is so important, that baseline, is because not every trade is going to be your exact entry confirmation. You need to be able to react and adapt. You need to be able to see how good is the context area that I'm trading from, which is something that we're also going to go over in the next video. But to give you a personal example, I actually, in almost every scenario, I require a lot more confirmation than my baseline, simply because I always want to take the highest probability trade ID. Then there's also 3 more things that are important, and that is regarding your risk management. And the first thing is our trade management. We have already gone over the first 2. So a stop loss above an order flow lag. 2 RR, ideally within the context area. Again, the further you target, the lower the probability is that we are actually going to reach the target. Then break even when there's no reason to return based on order flow. So what does that look like? Here we're looking at Canadian dollar JPY at the 4 hour context area right here, from that 4 hour value gap to the 4 hour low. and the intermediate low on the 5 minutes. Now on the 5 minute right here, if we take 2 order flow lags, we have the first one right there, and we have the second one, like discussed earlier as well, right there. We enter, for example, in the fair value gap. If you always want to enter in the fair value gap or the fair value area, also determine that. That is just purely personal preference. It's again, pick your poison. Cover the swing high that we have right there. So the swing high of the order flow lag, the most recent order flow lag that you enter in. Then you want to go break even when there's no reason to return. And when is there no reason to return? When I say there's no reason to return, I of course mean no reason to return to our entry level. So that's where we place our stop loss eventually, at the entry level. And there is no reason to return to our entry level if we create an order flow lag below our entry level right there. So here we see this new order flow lag right there, which the swing high is below our entry level. That means that we can perfectly fine go break even at that moment in time because there's no reason to return anymore. And if we do return, then most likely we are going to go higher. So break even in a bullish scenario is order flow lag above your entry. And in a bearish scenario, like we see right here, order flow lag below your entry. That's when you can go break even. Then after trade management, we also need to understand trade frequency. There is no reason initially to trade more than 1 time a day. So 1 trade a day, meaning it's going to be 0 trades because there's no trade opportunity. You don't need to trade every single day. But if you do take a trade on a day, then stop. It's either going to be a break even, a loss, or a winner. No matter the circumstances. So no matter the outcome. If it's a loss, a winner, or a break even, you stop trading for that day. This is quite important as well for discipline and overcoming psychology obstacles. Then eventually, if 1 trade a day goes well, then we can potentially look to increase the trade frequency if absolutely necessary. If our data tells us, hey, there's multiple trades a day that we can capitalize on. If not, again, there's no reason to trade multiple times a day. Then after trade frequency, we also have to understand risk allocation. And I've written down right there, boundaries. When you are looking at prop firm challenges, I want to first of all mention there is absolutely 0 reason in the world to risk your full maximum drawdown or go full margin on any single trade. That's not going to help you in the long term. When you are looking to be A-booked by a prop firm, when you are looking to trade for investors, they are looking at your equity curve and how volatile your equity curve is. So if your equity curve is constantly up, down, that's not good. But if your equity curve is very slow and steady, just up, or when you are in drawdown, is not a lot of drawdown, that is exactly what you want because that in the long term is very sustainable. Now that comes with risk boundaries. So what I mean by that, if you have a fresh account, for example, you can start off risking 1%. If you lose a trade or you go into drawdown, for example, 2% drawdown, you want to immediately decrease your risk to, for example, 0.5%. Then if you go into more drawdown, so let's say you reach eventually 3% drawdown, you want to go to 0.25%. Now, this is a very boring process to get out of drawdown. So the goal is to not get into drawdown in the first place, but it's going to happen eventually. It's just a matter of not making it worse. Now, you can also change the initial risk. So let's say on your fresh account, you use 0.5% risk, which is also perfectly fine, which I would advise to start off with. Then at 2% drawdown, you can go into 0.25% risk. So the parameters just change, but determine those boundaries for yourself. So write down your own risk management plan. I want to emphasize on the fact that if you are looking to trade for certain people, for yourself, for investors, even again prop firms, then it's not about the person or the trader who can make 20% in a month or 1,000% in a year. Because the first thing that comes to mind when investors see that, who are actually knowledgeable about trading as well, they will think, well, you most likely also risked a lot to get there. And every trade that you open is a risk on their side. And if you're trading personal capital, it's a risk on your side, which means that you create a very volatile equity curve because that 20% profit can turn into 20% drawdown at any given moment. Again, this is a marathon. It's not a sprint. The sprinters will be exhausted after maybe a year of trading and won't do it anymore because they won't see that long-term profitability. If you are looking to acquire a skill for the remainder of your lifetime, then long-term sustainability is the way to go, which is low risk. The goal is to increase capital, not to increase your risk. The capital needs to do the heavy lifting for us. Then the last thing, and again, for your own sake, a case study. Choose your entry and stick to it. Start studying your entry at context areas. You have everything already in your arsenal to know what type of entry you are potentially looking for and which time frames you want to use as well, because most likely you already know what type of trader you want to be. Like I mentioned right here, entries are supposed to be the easy part. It's not the difficult part. The hard work was already done before this video. Then we're going to dive into the top-down analysis and what type of trader you want to be as well in the next video. All right, perfect. Thank you.